Good morning. This is Susan Milazzo with the California Mortgage Bankers Association, and I welcome you to our February Mortgage Quality and Compliance webinar. Today's presentation will be very helpful. I've had a lot of questions on it recently, so this is very timely information that we're sharing. We'll start out with a new addition in 2019, which is the welcoming of our 2019 Mortgage Quality and Compliance Committee sponsor, and that is the Compliance Group. It's been an organization that supported our association for many, many years. And today I'd like to invite Jeff Flory to tell the group a little bit about the Compliance Group. Jeff, I'll turn it over to you.
Thank you, Susan. I really appreciate the opportunity to speak today. For many of our clients, there seems to be an endless parade of auditing agencies checking under the hood of the operational processes that you have. And these audits, while being part of, they're just a part of the mortgage business, they can be very disruptive and time-consuming to firms that are already spread pretty thin as they manage through an environment of, let's face it, razor-thin margins these days. The Compliance Group, for those of you who aren't aware, we have three main areas of focus: quality control for pre-funding and post-closing, compliance audits and services, and then service and quality control. And while our core business is really in the outsourcing of these services, we've also seen in the last several months an increased need from our clients to assist with both audit preparation and post-audit remediation work. And we have the ability to quickly and efficiently stand up specialty projects in advance of an on-site audit, or we can provide an independent validation of remediation after the fact. So give us a call if you find that you've got some work that needs to be done and you're spread a little thin. Give us a call. We can talk about how the Compliance Group can be your pressure relief valve when you need it. And if you'll be either in San Francisco for Ellie Mae's Experience Conference or the following week at California MBA's Legislative Day up in Sacramento, let's certainly set up some time to talk face to face. And Susan, I'll turn it back to you. Thank you.
Great. Thank you so much. I appreciate that, Jeff. And I was actually going to mention our upcoming Legislative Day, so thank you for that. Again, that's going to be on Monday, March 18th in Sacramento. It's a great opportunity to come and hear from our lobbying team about the legislative measures we are following this year. Certainly the privacy bill that was passed last year will be a topic of a lot of activity and conversation this year. We're also having a presentation on tax reform in general. Our organization's been very active in the California Budget and Tax Research Project that is focused on developing research to educate policymakers on the impact that a tax on services would have in the state of California. So very important work that we're doing this year, and again, that'll be part of our legislative day.
Susan, can I just make one comment? This is Jeff again. And for those of you
Sure.
who haven't participated in Legislative Day, and I've done it both with the California MBA and on a national level. In fact, Melissa Richards and I, one of your panelists here, we spent a day wandering around Washington together. If you haven't done that yet, I highly, highly recommend that you participate in California MBA's Legislative Day. It's really it's a fun time understanding kind of how the sausage is made in Sacramento.
Okay. Ready to go.
Okay, thank you, Jeff. I appreciate that. Yeah, great opportunity. I do really look forward to that event for us each year. So I'd like to turn it over to Monica McCarthy, who can introduce our legislative update for this call by Pat Zenzala.
Great, thanks so much, Susan. And on behalf of the CMBA and my co-chair Carol Carson and myself, we're pleased again to have a legislative update by our legislative advisor, Pat Zenzala.
Thank you very much. Can you hear me okay?
Yes, we can.
Perfect. So just to give you a sense before I start on the actual bills, where we're at in the legislative calendar, the 22nd of February was the deadline for introduction of bills. And so we had a few thousand bills introduced at the end of last week. So we're quite literally still in the process of sifting through and identifying bills of interest. So handful of bills that we're talking about today just are really a sample of some of the issues that I think we're going to be facing here in California this year. So the first bill is one that we're supportive of. It's AB 199. There's a similar bill introduced last year that we supported. It's to create basically an online notary act. So remote notarization, the ability to perform those duties over the internet, basically setting up a regulatory scheme for online notarization. So, and we've used the MBA model language that is moving from state to state. So we're hopeful that this year we'll be successful in supporting and seeing this bill move to be signed by the governor. The next bill I want to talk about is AB 873. This, I'm actually going to be talking about two bills that relate to the California Consumer Privacy Act. These are just a couple of, there's probably 20 plus bills that either directly or indirectly affect the new California Privacy Act that passed last year. The good news is there's a Glba exemption for information that's covered by the Glba, so there is a broad exemption in the Act, but there still are requirements under the Act, and we're still watching very closely. It was passed in a very short time frame last year. The original Act was passed in 7 days to avoid a threatened ballot initiative that had qualified, and the ballot initiative was actually much worse. So we're in the process of working with allies in other industry segments to see if there are additional changes that we can make to the Act to improve how it will work and to make compliance more understandable. As an example, we're looking at issues like creating a better definition for consumer so that it doesn't apply to business transactions and it doesn't apply to employer-employee transactions. Looking for a narrower definition of sale to truly mean what people think of when they think of sale versus just sharing of information to move forward in a transaction, and trying to make easier to comply with the requirement that you have to delete or share every piece of personal information about a potential consumer versus categories of information that you might be utilizing. So those are the types of issues that we'll be dealing with, and AB 873 is one of several bills that will be dealing with those types of issues. For the moment, it's just what we call a spot bill. It's a placeholder, and more substantive language will be put in it later. In addition to, like I said, there's probably 20 other bills in this topic area. The next bill is SB 482. This bill actually is really, we're told, focused on smaller consumer loans as far as the trying to deal with the issue that, in California under the California Finance Lenders Law, where there are very high interest rates for smaller loans. I'm talking about interest rates, above 100%. But unfortunately, the bill, as it's currently drafted, would actually impact any size loan under the CFL and would affect not just consumer, what we think of as consumer unsecured or auto secured, but also would impact mortgage secured or real estate secured loans and commercial loans. So that's very problematic, and I think we have concerns, and hope that it's focused on what we truly think it's trying to deal with, which is small loans at very high interest rates. And then the final bill is SB 561. This is once again on the Consumer Privacy Act. The concern with this bill is when the Consumer Privacy Act was passed last year, a private right of actions under the Act were limited to the provisions that deal with security breaches and data breaches. And the other portions of the bill that deal specifically with data retention, information, provided to consumers as far as information you collect and utilize, et cetera, they did not have a private right of action. They would be enforced by the Attorney General. This bill intends to essentially broaden the private right of action requirements so that it applies to all aspects of the Privacy Act. So I think we're going to have some real concerns about that. And with that, those are the bills that I wanted to focus on today.
Great. Thank you so much, Pat. And so next up, we're going to introduce our panelists for our topic, Understanding the New VA Rules for Cash-out Refinance Programs. First speaker that I will be introducing is Melissa Richards. She's a partner in Mayor Brown's Northern California offices and a member of the Financial Services Regulatory and Enforcement Practice and Consumer Financial Services Group. Melissa, who many of you know, recently served as the Chief Legal and Risk Officer at national mortgage banking firm of CMG Financial. She's been both in-house counsel and prior to that in private law practice for nearly 2 decades, with a nationwide client base and specializing in federal and multi-state regulatory compliance and licensing for the financial services industry. And Melissa also previously served as outside general counsel to the California Mortgage Bankers Association and as a member of its board of directors. And she's very active in the industry. Next up is Chris Birk of Veterans United. Chris is the Director of Education for Veteran United Home Loans and author of the book on VA Loans, An Essential Guide to Maximizing Your Home Loan Benefits. Chris's articles and analysis have appeared at the New York Times, the Wall Street Journal, the Washington Post, ABC News, CBS News, Fox Business, and more. More than 290,000 people follow VA Loan Insider, his interactive VA loan community on Facebook. Next up is Steve Condron. Steve is Operations Counsel for Veteran United Home Loans. He assists with statutory, regulatory, and investor guideline interpretation for production and servicing operations for them. So with that, I'd like to pass it on over to our speakers to proceed with our presentation.
Thank you, Monica. Can everybody hear me okay?
Yes, we can.
Okay, thanks, Susan. And then I will wait to take control of the slide.
You should have it.
I should be in control now. Okay. Then I see Chris Birk.
Try one more time. Come off and try you. There you go.
There I am. Okay. So we are gathered here today to talk about a new Veterans Affairs Department interim final rule on VA guaranteed or insured cash-out refinance loans. That interim final rule took effect earlier this month, February 15th. It's an interim rule in that the comment period for this rule also ended on February 15th. So we know that the VA has received quite a number of comments on this rule and requests for clarification and, backfill of instructions on specific areas to comply with the rules that I'll touch on. So we need to be cautionary here that this is a rule that will evolve over the course of this year and perhaps into next year. Why do we have a new interim rule on cash-out refinances today? Well, because in the spring of last year, Congress concluded that there was a problem with VA loan refinancings, and that they found conclusively to be a problem with churning of refinance loans to the detriment of service members, meaning that these service members were not getting the net benefit from refinancing an existing VA loan into a new VA loan. They found instances of equity stripping through the new loan, and also incidences of service members paying high fees for a reduced interest rate on a refinance loan that didn't really compensate or reflect the benefit. The amount of interest rate reduction was not commensurate with the amount of fees being paid for that loan. Now, Congress, for the first time, found there to be a distinction in the cash-out refinances. And so that has prompted the VA to recognize there to be a type 1 type of cash-out refinance versus a type 2 cash-out refinance. The type 1 exceeds the payoff amount of the old loan. The type 2 does not exceed the payoff amount of the old loan. Also want to note, for purposes of this slide, you're not seeing a third bullet for VA IRRRLs. VA IRRRLs are not covered by this rule. They will instead be covered by a different, separate rule to be published by the Veterans Administration sometime later this year, they think. All right. Let's go to the new eligibility criteria for all cash-out refinances other than these IRRRLs. Number one is dealing with the equity stripping problem. The new rules place a limit on the loan-to-value ratio of 100% of the home's reasonable value. And coupled with that are funding fees. Now, the funding fees can be paid by the service member on the refinance loan upfront in cash, or it can be financed. But again, the funding fee portion of being financed cannot overall exceed the aggregate LTV limit of 100%. Previously, funding fees could be financed and cause the aggregate LTV to exceed 100%. So again, no more of that, no underwater service members. The third criteria, and this is the thorny one, is the net tangible benefit test must be satisfied. And you know, this is a significant improvement for the VA cash-out refi program. But with NTB tests, as we've come to experience, you know, in the past, there's always issues and questions that are raised on how to satisfy net tangible benefit tests. So this test has 3 parts. Part 1 is the refinance lender must show that the new loan will meet one of 8 criteria as compared to the loan being refinanced. So we run through this, you know, it could eliminate monthly MI, it could be a shorter loan term, it could be a lower interest rate, a lower payment, it could result in higher residual income to the borrower. It can refinance an interim loan to construct, alter, or repair a primary home. It can have an LTV ratio of 90% or less, or it can refinance an adjustable rate loan to a fixed rate loan. That all sounds great. The issue with this is how does the new lender obtain the information on the existing loan and able to run through the 8 criteria and identify which one or more of the criteria fits the particular loan refinance transaction. And that leads us to part 2, and that's a disclosure requirement. The new lender must provide a comparison certification to the loan applicant service member within 3 business days of receiving the application, and that identifies the criteria being met. In addition, the same certification, but without estimates, and rather with exact information, must be provided to the service member at the time of loan closing, which is not a defined term because state laws define the term differently. Why do we need this certification? Well, VA writes in its final rule, interim rule preamble, it requires lenders to provide the borrowers with the information on 2 separate occasions to enable those borrowers to better understand their cash-out refinance loan transaction and therefore make a sound financial decision. And VA believes this information will help borrowers avoid costly mistakes that may strip their home equity or make it difficult to sell or refinance their home in the future. So in other words, the VA is forcing service members to become better shoppers, and armed with better information, comparing their existing loan with the desired cash-out refinance loan, the service member can make better financial decisions for themselves and for their households going forward. The interesting part here, and this is where interim final rule comes in, is that under the existing rule, there is no express requirement that the existing lender provide the comparison information to the new lender or specify time periods in which that information must be delivered. Now think about state laws on loan payoff statements. State laws get real specific on the kinds of information that must appear in the payoff statement and the time in which the payoff statement must be delivered to the new lender or into escrow from the date that it's been requested. This rule is silent on that process, and that's a key area where I see the VA needing to circle back on that issue and refine its rules accordingly. All right, next slide. All right, part 3 of the net tangible benefit test is there must be a meaningful interest rate reduction on the cash out refinance. And the rule sets a bar, a minimum bar for the reduction depending on the nature of the existing loan versus the nature of the new loan. So if the new loan is a fixed rate loan and the existing loan is a fixed rate loan, the interest rate must be reduced by no less than 50 basis points. If the new loan is a fixed rate loan and the existing loan is an adjustable rate loan, then the interest rate must be reduced by at least 200 basis points. Now, if the new loan is adjustable rate and the existing loan is fixed rate, there's 2 components. One is an interest rate reduction by at least 200 basis points and a limitation on the financing of discount points. So the discount points can be paid at closing without limitation, but if they're sorry, I'm saying this wrong. The discount point must be paid at closing and cannot be financed. Sorry. In addition, the discount point cannot be greater than 1 if the resulting aggregate loan to value ratio is exceeds 90%. Okay, so a fixed rate loan to adjustable rate cash out refinance loan, you've got those 2 components, discount point and interest rate reduction, to contend with. All right, so with that, I'll turn the controls over to Chris and Steve to finish off the presentation. Thank you.
Thank you, Melissa. This is Chris, and I'm going to go through the last two criteria, and then Steve and I will talk about some practical considerations and recommended solutions. So the fourth criterion looks at fee recoupment. And so right now, fee recoupment is applicable to type 1 cash-out refinance loans. And again, the type 1 cash-out is where the new loan, and that's including the funding fee, the new loan does not exceed the payoff amount of the old loan. So again, a type 1 cash out is where the new loan is equal to or less than the payoff amount. So in those cases, everything has to be recouped at or before 36 months after the date of loan issuance. And it's calculated by looking at P&I reduction as a result of the new loan. And similar to how it works now with the interest rate reduction refinance loan, the VA IRRL, a lender has to provide documentation to VA that clarifies and details the recoupment period. And recoupment similarly is also not including escrows and prepaids. Just like with IRRLs, they're not included for recoupment calculations on cash outs. Let's see if there we go. And the last one is looking at loan seasoning. And so seasoning requirements are applicable to all of the new cash outs, so both type 1 and 2, so long as they're made to refinance a VA backed loan. And so from a seasoning perspective, right now, both of these conditions have to be met as of the date of loan closing. And the first is that the first monthly payment of the loan that's being refied was made 210 days or more prior to the closing date of the refinance loan, and 6 monthly payments must have been made on the loan that's being refinanced. Now, in cases where loans are being refinanced within a year from the closing date, lenders can either get a payment history or ledger that's documenting all the payments, or, and this was a relatively recent clarification from VA, they can use a credit bureau supplement as long as it clearly identifies the mortgage payments made in that time frame. And now Steve's going to talk a little bit more about some practical considerations and solutions.
Hi, this is Steve Conner. Some of the things that we've been working through in implementing this rule and the clarifications that the VA put out on the 14th involve helping our borrowers understand what it is we need to be able to get this disclosure out to the borrower. You know, whether that looks like their mortgage statement to be able to determine what the get a better idea of what the payoff amount will be, what their interest rate is, things like that. I know we encounter a significant number of the time where borrowers just don't know what their interest rate was. They may have originated the loan a number of years ago, and so we want to try to find as many ways as we can to help them get that information. Some of the things, kind of along that line, we've had to make sure our loan production staff, our loan officers, and different people that talk to the borrowers are comfortable with the fact that the borrower's best guess in these on these figures that are used to populate the loan comparison, they're good enough. In the circular that was released on the 14th, the VA actually specifically said that information provided by the borrower will fulfill the requirement needed for the initial 3-day disclosure. Obviously, as you progress in the loan process, you're going to gain more information. You might be able to get a copy of the original note. You may be able to get those payoff information from the current servicer. That helps you refine the information that's going on the initial disclosure. So we've had to put some processes in place to update the disclosure and try to get that out to the borrower in a timely manner when there's actually been an appreciable difference made to the information there. The VA also made it pretty clear that the final closing disclosure, the version of the loan comparison that's going to go out at closing, obviously, is going to need to be as accurate as possible. They did allow for some fluctuation related to payoff figures and prepaid days interest and things like that, but you want to have that be as close to the final numbers that you can give the borrower as possible. Some other things, we've had to work on training our staff on how to explain things like total of remaining scheduled payments. Obviously, whenever you're showing a borrower a 30-year fixed to a 30-year fixed, and maybe they've been paying for 7 or 8 years, that number is going to look better on their existing loan than the new loan. So explaining to borrowers why that might look different and why a refinance, if that's what they want to do, but why it may make sense in their situation, even though obviously their remaining scheduled payments are going to increase. These, at least the initial loan comparison and the one presented at closing, need to be signed. Any others that you may send aren't required. The VA did say that they strongly, or I don't know if they use the word strongly, but they encourage lenders to send additional copies of the loan comparison to borrowers throughout the process as numbers are changing. I don't know that those have to be signed, but obviously the initial and the closing one do. So making sure that you've got a process for that. Some of the discussions internally we've been having relate to how often do we want to send these? Do we want to send them with every loan estimate? Obviously, just the things that would create a change of circumstance that may lead you to send a revised loan estimate don't necessarily impact all of the information that tied to the loan comparison. So making sure that your LOS has the ability to segregate when you send the loan comparison versus an LE, things like that. Do you want to send it with the initial closing disclosure so that you kind of need a 3-day wait on that? Or do you only want to do the initial LE and the final CD that will be signed at consummation? Those are all questions, your organization has to make a risk determination on, but those are some of the things we've been talking about. I also think something that I failed to put on the slides, but another consideration is whether your LOS supports the total loan to value calculation that is now required for cash outs. Obviously on VA purchases, it's a different loan to value calculation whenever you're talking about base loan amount. So I know some LOSs don't natively support a total loan to value calculation in the way that it's needed for the VA cash out rule now. So I think questions would be next.
Okay, great. Thank you. I very much appreciate today's presentation. I know that we do have some questions. So if you haven't already done so, you can look at the question dialog box and pose your questions now. There are also 2 handouts that are available to you in the handout section if you would like to download those. They're available there. So let me look at some of the questions that have come in and get to these. We already have a few. There was a question said, am I missing something? But if the new loan doesn't exceed the payoff amount of the existing loan, how is this a cash out refinance? Does Melissa, Steve, or Chris, do you want to address that question?
Well, I think it wouldn't be traditionally what we consider a cash out refinance. It would look more like the rate term finance in the FHA and conventional space. The VA loan product hadn't previously had a rate term product, and so I think this may be the creation of something like that.
Okay. Next question is, do you know if other lenders are putting a specific reason how the reduction of home equity will affect the borrower in the future?
I have not seen a specific explanation of how it may impact the borrower. In the sample certification that the VA put out with the February 14th circular, there is something that there is a line on there that shows the home equity remaining and that it would be obviously reducing it. I know I have seen some language that would indicate to the borrower just that it may impact their ability to refinance later, depending on that. But I haven't seen anything specific.
Okay. Okay, next question. As opposed to I think that meant to be signing, 261905 states the borrower must certify receipt of both disclosures, i.e. signature, e-signature, email from the borrower certifying receipt, email read receipts, system time date stamp where a borrower certified receipt, etc. I don't know that that's a question. It seems like it's more of a statement. If Brendan would like to repost that or send it in a question, that we can try to get to that before the end of today. The next question is, what efforts are being made or can be made to push the LO's providers to install the comparison disclosure?
I would say that's just all of us as lenders trying to make our LOS providers aware of the need. I know we are in talks with, we talk to our LOS provider all the time, but that's the way I think we can impart the importance.
Okay. Next question, is the funding fee included in the recoupment?
No, it's not.
No, okay.
No, prepays and the funding fee would not be included.
Okay. A couple more questions. How do you recommend completing the disclosure when there is more than one lien being paid off, so the repayment terms differ for each?
In those circumstances, what we have taken the approach of doing is trying to combine the loans or whatever the liens are going to be paid off, trying to combine the information for the existing loan column. As that really gets to then the NTB test that's being met, like if it's the residual increase in residual, that showing what the payment difference would be, so it's more of an apples to apples type comparison whenever the borrower is looking at the disclosure.
Okay. Next question is for Melissa. And I'm sorry, if you are a panelist and you're not speaking, if you could mute your line, I think that's causing us to get some background feedback. Thank you. Next question is for Melissa. It says, Melissa commented that there is an interest rate reduction requirement. I see that is one of the 8 NTB criteria, but don't see that as a separate requirement in the circular 2619.5. Can you clarify?
These slides were created directly from the rule as it was published in the Federal Register, and the rule lays out the NTB test in those 3 parts.
Okay.
If you for access, because it's not a handout, where you find the document on Federal Register, it's Title 83 Federal Register, page 64459, and you'll see that site on slide 2 of our presentation.
Okay, thank you, Melissa.
Yeah.
The next question, the speaker spoke of requiring certification by the borrower signing, but the VA provides other means of certification. So I think that might be going to Chris and Steve.
Yeah, I don't think that signing is necessarily the only way for the borrower to certify receipt. That's just the method that we've chosen to go with. It just seems the cleanest way for us. But yeah, I wouldn't say that that is the only way to certify receipt.
Okay, great.
It has to be
lots of great
auditable,
questions
right?
here.
Yeah.
What's that, Melissa?
My statement is that the certification of receipt, whatever the manner, it has to be auditable, through loan file examination or QC process or VA's own guarantee process.
Right.
And again, this is a sample certification form that the VA offered up, and it's February 14th circular. They do have signature lines, but it's, you can do e-sign or devise some other way as long as it's, a reliable method.
Got it. Good point to make something that, look at it through the lens of something that could be auditable.
I think that's a good point Melissa just made.
Go ahead, I'm sorry.
A good point Melissa just made is that it does need to be auditable, because there is potential impact on your guarantee if you can't show that these disclosures were provided to the borrower. I believe the circular allowed for loss of guarantee or up to 5 years indemnification for failure to comply.
Okay, next question is, how do we calculate the remaining payments on the existing loan when MI exists? And how do we determine when MI terminates?
That one's tough, and it's something we've been struggling with ourselves. We've used reverse amortization calculators, things like that, to try to figure out what the value of the property would have been at the time the original loan was made. I think what's important is that at least for the initial 3-day disclosure, I think the VA has made it clear through webinars and through the circular that lenders have some flexibility, because they may not be operating off of the absolute best information that's out there, but you have to make a reasonable inquiry into the state of the current loan when generating that disclosure. So, I think it just has to be something that your team has to get comfortable with, and a way to make those calculations and what kind of assumptions you're willing to make.
Okay. We have a couple more questions here. How are the other lenders helping to determine the total of the remaining payments on the current loan, running an amortization schedule outside the LOS?
I can say that's one of the ways that we're doing that, yes.
Okay. Next question, doesn't Part 3 rate reduction only apply to Type 1 refinances?
Turning the page. So that let me turn to the rule.
Let's, while Melissa's looking for that, let's go on to one last question here at this point. In the recoupment calculation, when considering total fees, Section E states excluding taxes. Does that include intangible taxes? Can you define taxes? Is that
I think
something
that's
maybe that Chris and Steve know?
I would say I think that's a good question that hopefully the VA will be able to provide some clarity on. We have been viewing taxes as inclusive of pretty much all real estate property taxes. But yeah, that may be something that we'll get some clarity on down the road.
Okay. Melissa, have you found that the Part 3 rate reduction section?
No, I'm looking for the rule.
Okay.
I can say I did not find that distinction when I prepared that slide.
Okay. We just got another question that had come in. For the comparison certification at loan closing, should sections 1 and 2 continue to reflect the estimated disclosures rather than updating those sections to reflect final disclosures, i.e. include final disclosures only in sections 4, 5, and 6?
I think that's where, yeah, I think those numbers in the current loan column is where I'm guessing the question relates to. In the current loan column, I think as you get better information, what the VA has asked is that those numbers be updated to show the borrower exactly what's being, the terms of the current loan that's being refinanced versus the new loan that the borrower will be entering into. I hope that's responsive.
Okay.
And this is Chris. And on the interest rate guideline question, our understanding is yes, it's type 1 that the interest rate reduction requirements apply to. It's solely type 1, which again is where the new loan does not exceed the payoff amount of the old loan.
Thank you, Chris.
Yeah.
Okay. And just to reiterate, we had a question about the PowerPoint. We don't post the PowerPoint, but the recorded webinar is going to be available on our website probably in the next few days when we can get it downloaded and posted. And it'll be on there on our public side of our site for about 60 days. And then after that, it is available to those who are with member companies of the California Mortgage Bankers Association. We do have another question that has come in. Section B of the Federal Register speaks to only one type transactions being covered by the rate reduction test.
Okay, that was just answered.
Okay. Okay, let's see, we have one other question that's just come in. Can you think of a situation where the service member will be better served by a type 1 versus IRRRL or type 2?
Oh.
Off the top of my head, I can't necessarily think of one. I will say on the VA, whenever discussing this on webinar that I heard them talking about this on, said that they estimate type 1 refinancings will be 3% or less of all cash-out refinancings.
Yeah, the funding fee would be the big consideration there. If the borrower is not exempt from paying the funding fee, it would be significantly higher for a cash out. The funding fee on an IRRL is 0.5%. So it would be a significantly higher funding fee that you'd have to pay. But yeah, we wouldn't expect it to be a sizable number for the type 1.
Okay. Well, again, speakers, thank you so much for your presentation today. Greatly appreciate it. Lots of great questions too. Thank you for the attendees that participated. I just want to make sure that you all know what our topic will be next month on March 28th. We're going to have an update from some of the hotter topics that were part of the recent NMLS conference, including discussion on mortgage call reports. We are fortunate enough to have Rosalind Hardy, who's President and CEO of QCP Systems, and Tim Lang, who's Director of Licensing at Approved. So if you received the link for today by someone forwarding it to you, I invite you to send your information to me Susan Milazzo with the California Mortgage Bankers Association. My email is susan@cmba.com, and I'll make sure that you get added to the announcements for future webinars. So thanks again for your participation today. I wish everyone a great rest of the week, and we'll see you next month.